Hey guys, welcome back to another episode. In this video we will be going through our top 4 most powerful price action bar patterns trading system. If you want more videos more often, please smash the like button, subscribe, and turn on the notifications bell, and share this video across your WhatsApp, Facebook accounts, or Twitter to show your support. A very important point before we start. Everything we discuss in this video can be used for currency trading, stock trading, and crypto, because price action stays relatively consistent across different assets, so we're going to go very in-depth in this video. Top 4 most powerful price action bar patterns trading system you must know. Choosing which trading system to use in forex, stock, crypto, or futures is one of the most crucial and important decisions you must make as a trader, but with so many different systems out there, the question arises. How do you know which to pick and use in your trading? It's not an easy decision. So, in this video, I want to share with you the top 4 most powerful price action bar patterns trading system. These 4 trading systems require nothing but a price chart. And now, let's take a look at the first system. System number 1. Pin bars at support and resistance levels. What do you get if you combine 2 of the most useful and well-known price action concepts together? The answer is a very good and high probability trading system. Trading pin bars at significant levels of support and resistance is one of the oldest trading systems around, but it's one that still performs extremely well today. It's easy to learn for beginners, provides a good number of profitable trading signals, and best of all, you only need to mark some support and resistance levels on a chart. Wait until the price reaches one, then see if a bullish or bearish pin bar forms. First, if price hits a support level and a bullish pin forms, you enter a buy trade. And second, if price tags a resistance level and bearish pin forms, you enter a sell trade. Let's go through a quick example. Here's a bunch of support and resistance levels I marked on a chart of Euros United States dollar. If you look to the right of the chart, you can see price has just fallen sharply and is now close to hitting the support level at the bottom. The line marked blue. If price hits this level and produces a bullish pin bar, it'll be a signal for you to go long. The pin forming at support suggests the banks and other big traders want price to rise. The support being a key point they would want a reversal to take place from, the pin confirming their interest at that level. And what happens next? A bullish pin bar forms. This pin bar confirms price has a high probability of reversing away from the support level. It doesn't mean price will definitely reverse and move away, but it does make it highly likely. So, upon seeing this pin bar form, enter a buy trade, place your stop loss slightly below the low of the pin, then see if price reverses. If everything works out as it did here, you should get into a nice profitable long trade. For trading resistance levels, you follow the same process. You wait for a bearish pin bar to form at resistance, place your stop just above the high of the pin bar, then see if price reverses. Very easy, right? Here are other examples of the pin bars trading at support and resistance levels. System number 2. Engulfing candles inside supply and demand zones. Trading engulfing candles inside supply and demand zones is an offshoot of the supply and demand trading strategy popularized by Sam Seaton. And it's one of the best reversal strategies on this list. There are two types of zone. First, supply zones, points where the price is likely to fall. Second, demand zones, points where it's likely to rise. And now, the normal way of trading supply and demand, the way taught by Sam Seaton, is to place a limit order at the edge of a zone and then wait for price to, hopefully, execute it and reverse. However, it's much better to wait for an engulfing pattern to form inside the zone before entering. Engulfs form when the banks enter the market and conduct some kind of action, like place trades, take profits, and close trade. So, seeing one form inside a zone provides greater confirmation price is actually going to reverse. Here's how it works. First off, mark a few supply and demand zones on the chart. I recommend only marking the ones closest to the current price, so the chart doesn't get too cluttered. To draw the zones, again, I'm really simplifying here. Find the bottom of a sharp rise or the top of a sharp decline, and draw a rectangle from the open of the last small candlestick that formed before price jetted away to the most recent major swing high or low. Swing low for sharp rises, and swing high for sharp declines. With the zones marked, the next step to wait for price to return, and see if a bullish or bearish engulfing pattern forms within, or when price touches the outer edge. For demand zones, a bullish engulf must form. For supply zones, a bearish engulf has to form. In our case, a bullish engulf forms a few hours after the price hits the zone. The engulf confirms the price. The banks want price to move away from the zone, making a great signal a reversal be about to begin. So now, you enter a buy trade and place your stop loss just below the opposite edge of the zone. If you're trading supply zones, it's the opposite way around. Wait for the price to hit the zone and see if a bearish engulfing pattern forms. If it does, you enter a sell trade and place a stop above the opposite side of the area. Here are other examples of the engulfing candles inside supply and demand zones. System number 3. Trading pin bars at trend lines. This has been a staple price action trading system for decades now, providing high probability low risk entries into trending moves or big swings. It's extremely easy to trade too, and only requires you to follow 3 simple steps. First, draw a trend line on an up or downswing. Second, wait for price to return to the trend line. Third, enter upon seeing a pin bar candlestick form. The key thing to remember, which almost everyone gets wrong, is always draw the line on the swing highs or lows of the swing, not through the bodies of the candles. When you draw the line on the candle bodies, the points won't add up. Price will often reverse after breaking the line. Or won't touch the line in the right place, not giving a valid signal entry signal if a pin bar forms. To ensure this doesn't happen, always draw the line on the swing lows or highs that make up the move. This will give you the right trend line and allow you to trade pin bars at trend lines correctly. Here are other examples of the trading pin bars at trend lines. System number 4. Pin bars and engulfing candles at Fibonacci retracements. Another great strategy, or setup I think, is a better name for this one, you should add to your arsenal of trading systems, is trading pin bars and engulfing candles at Fibonacci retracements. Much like trading support and resistance levels, trading pin bars and engulfing candles at Fibonacci retracements has you enter trades when price pulls back to a Fibonacci retracement and forms a pin bar or engulfing pattern. The retracement levels provide likely spots for the pullback to end, so seeing a pin bars or engulfing candles form confirms a reversal could be nigh. For the most part, trading pin bars or engulfing candles at Fibonacci retracements is an easy system to use. You draw a Fibonacci retracement on an upswing or downswing, wait for the price to return to one of the retracements levels, then enter a trade upon seeing an engulfing pattern or pin bar form. Sounds very easy, right? Let's go through a quick example. So first of all, mark a Fibonacci retracement on an upswing or downswing. To find the retracement of an upswing, place the tool at the lowest swing low of the upswing and then drag it up to the highest swing high. For downswings, it's the opposite. Place the tool at the highest swing high and then drag down to the lowest swing low. And now, you only need to wait for price to return to one of the levels and see if a pin bar or engulfing pattern forms. The type of pin bars or engulfing candles that must form depends on whether the retracement has been drawn on an upswing or downswing. For upswings, a bullish pin bar or bullish engulfing pattern must form. For downswings, a bearish pin bar or bearish engulf pattern has to appear. In our example, price rises to the 50% level and falls, causing a bearish pin bar to form. This pin provides some evidence the banks and other big traders are selling again, making it likely price is about to reverse and resume the downtrend, which it, of course, then does soon after. So, that's how you trade pin bars and engulfing candles at the retracements. And here are other examples of the pin bars and engulfing candles at Fibonacci retracements. Picking a good trading system is one of the keys to successful trading. With the 4 systems listed here today, hopefully, you now have some ideas of which you might want to use or add to your own trading. Remember, give each system a whirl on a demo account before using it. As always, if you learned something new, or if you want more videos more often, make sure you subscribe, click the notification bell, and share this video across your WhatsApp, Facebook accounts, or Twitter to show your support. See you next time.